Welcome, you're watching NDTV Profit. Today on the show, we're speaking with Patanjali Keswani, Chairman and MD of Lemon Tree Hotels. Now, the hospitality space has been an interesting one, and Q3 is one to watch out for a number of marquee events. You had the festive season, wedding season, World Cup, and now, of course, the December year-end rush. What is the picture panning out like? Mr. Keswani, welcome to NDTV Profit. So glad you're speaking with us today. Let's begin with that overview on Q3. Was it all that it was made out to be? When we were seeing exorbitant, room rates on social media for various occasions, tough to get a room at a decent price. That's great news for Lemon Tree, isn't it?
Hi, Tabana. Thank you for having me on this show. Well, Q3 actually, I think very often we get confused between festive season and demand. So when you have business hotels, and we have many of them, the demand is actually quite low during festive season because people don't travel, for instance, during Diwali or Dussehra. So while social activity is high, business activity is low. So for business hotels, in fact, Q3 is never as good as Q4. But for leisure hotels, certainly it is. So in our case, we have, only 20% of our portfolio is in leisure. So those will do well. And the others, which is the business hotels, typically do lower occupancies during this period. And it's an annual thing. Every Q3, you have Diwali and Dussehra, and God help you if it is in the middle of the week in November, because it significantly affects demand in what is traditionally a very high demand period.
Now, fair enough, but this time was different, and which is why I also mentioned World Cup, where I think all rooms of all categories were in great demand. Was that helpful to you at all? Is wedding season looking interesting, and would you say that same sort of slump, business hotel slump, will be seen year-end? How is that picture working out?
Well, certainly wedding season helps us, and the World Cup helped us in Ahmedabad and a little bit in Bombay and so on. But those are one-off events. You get me? So they don't move the needle across a full quarter, which is 90 days. So to answer broadly, the fact that Diwali was in the middle of November this year as opposed to last year when it was in October actually muted demand in October, which is a very high demand period otherwise. Weddings, they're certainly on the on the rise, and we are capturing more and more of that market, so that did compensate to some extent. As far as the year-end goes, Christmas and New Year's is again a period somewhat similar to Diwali and Dussehra. So our hotels in Goa will do well. Our hotels in some other leisure destinations will do well. But our large hotels in the cities will not do as well as they would do in a normal week as compared to the year end.
Fair enough. So let's look forward. Let's look forward to Q4 and the average room rentals that you're seeing. Are you seeing an uptick there possibly? Are you seeing an improvement in occupancy rates coming in?
Yes, absolutely. So Q4. So look, if you look at this business, which is somewhat cyclical, even within a year, it is. So one is it's cyclical over a cycle, which means it's a function of demand supply over an extended period, over a decade. So let me give you some context. The hotel industry, the cycle is typically, say, 10 years. And an interesting principle applies that whenever the demand goes beyond supply, and this is a little bit like the oil industry. So let me give you further context that in the oil industry, if demand goes up by 1% globally, prices go up by 10-15%. Okay, and why is that? Because it's got a limitation on supply. You cannot add supply quickly. It takes years to add supply, and therefore a small delta in demand growth means prices go through the roof. The hotel industry is not fundamentally dissimilar because you cannot put supply up overnight. It takes years. So whenever demand is beyond supply, the prices grow disproportionately. So that is our business. Now, when I look at Q4, Q4 is traditionally a period when demand is highest in among the 4 quarters. If you look at a full year, then H1 is when about 45% of your demand is generated, and in H2 it is 55. So really H2 is 1.2x of H1. And within H2, Q4 is 1.2 times or 1.1 times Q3. So every year, Q4 is the best quarter. And for us, as I see our forward bookings, it will be somewhat of a record-breaking year for us, a record-breaking quarter, to be specific.
Why is that? Can you add some more details there? Why will it be a record-breaking quarter in terms of occupancies, ARRs, or both?
It is both occupancies, ARRs, and the fact that we have opened the biggest hotel in India, which is in the deluxe segment, the 5-star plus segment, which is the Aurika Hotel in Bombay.
Yes.
And that alone will, be a gangbuster performance. So if you add it as some of the parts, the same hotels, as you call same stores, will themselves do significantly better. And then add to it Aurika itself, which will contribute 20% of our revenues, and over time maybe 30% of our EBITDA. That has got stable in this quarter. But look, I would like you to look at it slightly differently.
Okay.
I think whoever I talk to in the media or in the investing world, we always look at the hotel industry from the perspective of cyclicality, seasonality, and what is demand growth and supply growth in the short term. But I think something that is not yet been recognized, and I have no doubt it will be recognized in the next 2 years, is the change in consumption patterns. So India, as a matter of fact, and I'm going off the hotel sector, I'm talking about the consumer discretionary sector. India is at a very interesting point. See, at different levels of per capita GDP, there will be cohorts of consumers who move from discretionary to non-discretionary consumption of certain categories of goods and services. Let me give you an example of this. If you look back 20 years, the choice of traveling between Bombay and Delhi was between traveling by rail and or going by air. A very tiny portion of India would treat air travel as the default. That is, it would be non-discretionary. Today, look at the rate of growth of air travel in India. And the fact is, and as incomes in different segments keep increasing, those very categories of consumers who are also aspirational no longer think of traveling by train. They only think of traveling by air. The point I'm making is that what used to be discretionary has now become non-discretionary for an increasing number of customers in India as far as air travel goes. The same story applies, for example, in cars. 25 years ago, Maruti 800, and today, a heck of a lot of people now buying cars worth at least 10 lakhs or more. So these are inflection points in different buckets of consumption. The inflection point for the hotel industry really comes at about $3,500 to $4,000 per capita, when a very large portion of the population demonstrates a marked preference for branded mid-market hotels. You can look at China, you can look at Taiwan, you can look at every economy that grew through this, and you will find that hockey stick change in demand occurred at that point. What am I saying? I'm saying if the economy is growing at 7%, then yes, every year demand grows at 8-9% for the hotel industry, right? But there is one point in the economy, in every country's economy, when the number of consumers at a certain level of GDP per capita start treating that category as non-discretionary. And the hotel industry in India is 2 years away from that. So, at which point, Tamanna, you are not talking 7 or 8% demand growth. You're talking 3x, 4x demand growth.
Okay, so I'm going to ask you why you think we're 2 years away from it, and because you have properties in all categories, are you seeing this shift upwards to, for example, an Aurika, which, your projections have increased from 15 to 20 to now 30% of revenue. Are you seeing that shift upwards in numbers in a very clear way, in a very clear fashion?
So here's the deal. Let me just give you an analogy. 3 or 4 or 5 years ago, before COVID, let's assume the number of consumers for mid-market branded hotels was, say, 10 million households, okay, which is roughly 45 million people, 4% of India's population. Today, that number is no longer 10 million households. An increasing number of people, because India's GDP has grown 30% since then, the number of people who can afford mid-market hotel rooms has tripled. Okay, the number of people who can afford luxury, what you are talking about is premiumization.
Yeah.
That has probably grown 5x. So luxury demand in India, whether it is for hotel rooms or business class tickets or just nice handbags or branded products, is going to, in my opinion, is already on the route to taking off. The mid-market is a couple of years ago. Now, why do I make this point? I'll tell you an entertaining anecdote. I read that in some markets, when mid-sized SUV consumption takes off, the hotel demand takes off 4 to 5 years after that. So as I said, as an amusing aside, I'll tell you, every time I sit in my car and I look out, I count the number of mid-sized SUVs. And I was very pleased to hear, even from Maruti Suzuki, that they now regard that as their most important market.
Yeah.
So these are proxies, these are, ways of assessing. But I can tell you on ground, I can see this move. I certainly see it in the premium segment. In the premium, it's a little bit of a tongue twister, but in the move in luxury demand, and mid-market brands typically follow 2 to 3 years after that.
So in terms of where your average room revenues will move with this trend, what is that trajectory looking like? From about
so I'll take you back.
5,000 odd right now, 5,200 odd right now.
We are now at about 6,000 ARR, okay. But okay. That's a blended average. So our lemon tree premiers would be at 7 to 10,000. Our lemon trees would be 5 to 7. Red foxes would be about 4 to 6. So you're talking of an average.
Yes.
And these are different consumer cohorts again. So if I go back, you tell me the prices are high, and I said in a recent interview that that's incorrect, because 15 years ago, compared to 15 years ago, which was the last top of cycle in India, in the hotel industry, my prices are 30% below that today. So 15 years of inflation, 15 years of holding assets, and my prices today are 30% below what they were at the top of the cycle. So here's the point. Top of the cycle is purely a function of demand exceeding supply incrementally annually, which is already in play as we speak. That will lead, in my opinion, to a 10 to 20% increase in prices across India in different markets, where obviously in some markets demand growth is greater than supply growth by a certain level, and in other markets it is perhaps less. So depending on those factors, your prices will go up between 10 to 20% in markets. Blended, maybe 12 to 15. But if this hypothesis, which I just shared with you, plays out, which is an increasing number of people treating branded hotel stay as non-discretionary, then prices will go through the roof. Then I don't even want to speculate where it will be, but I do know that, there's a saying, you ain't seen nothing yet. And I think that's where we will move towards.
So when you're saying prices go through the roof, you think demand will keep up?
Absolutely, because it is not the current demand that is growing. It is new cohorts of consumers who have started to also consume this.
Okay. Just looking back a little bit, industry-wise, just to get a sense, and of course you're right that ARRs, which I'm mentioning, are blended ARRs across your categories, but if industry standard was about 16%, lemon trees have grown about 7%, why is that? Is that because of the mix there? And
Yes.
are you aiming to move that figure upwards with a larger focus on luxury and higher end segments?
Not so. So when you say industry, the listed players in India
Yeah.
are all luxury except us.
Fair.
Okay. So what they are really reflecting, Taj, of course, is a more distributed mix, but certainly the other two, which is Chalet and Oberoi's, are basically in the luxury space. So those have an ability to reprice first. Okay. Taj has both mid-market and luxury, and of course with Ginger, what you can call is economy. So they are reporting a blended increase. We, in our case, most of our hotels are in the mid-market space, so they reflect what happens in mid-market. Now, if I break that 7% down, then I can tell you that in the Keys portfolio, which is an economy portfolio, our prices hardly went up. But that accounted for 1,000 rooms. Whereas in the Lemon Tree Premier portfolio, prices went up 15%. So in different segments, the prices go up differently. And what I report, obviously, as a company is on the blended figure. But across the board, I think there will be much larger increases in prices in this coming year. So that's the good news for the hotel industry and perhaps not so good news for consumers.
Okay, but if as you're saying, people are getting used to paying more on different standards and discretionary is becoming regular, then perhaps that will work up as well. I want to get a sense from you on management contracts, and you have gone on record to say that more and more focus will be on management contracts. I think they will account for about 70% of all of your inventory. How are you picking this? Is there enough inventory, or are there enough properties out there to execute these management contracts, and what are the challenges there to make sure everything is up to standard?
So context for you is the US is, of course, the most developed market. It has 5 million rooms and 70% are branded. Okay. Now it has 350 million population and 5 million rooms. So effectively it has, for every 70 people, it has one room. And for every 100 people, it has one branded room. In India, the total branded rooms are sub 200,000. There are, however, no numbers as to how many actual rooms there are in India because it's such a fragmented market.
Yeah.
If I look at Ministry of Tourism, it might mention 3 million rooms. If I go to, say, Make My Trip, it has 1.3 million rooms on its portal. So what are the number of rooms? Nobody knows. But my best guess is if I take legitimate rooms which are approved for stay of customers, it would be roughly 2 million. Now within that 2 million, about 80% are the kind of hotels you cannot brand because there is no product cohesion in them. There's no coherence. Each hotel is vastly different to the other. So the way I look at it is for Lemon Tree, the market is that 20%, which is say 400,000, 300,000 rooms. We would go all out to manage / brand those rooms. And for the remaining market, remaining addressable market, which is say 1.6 million rooms or maybe less, we would use Keys as a soft brand, which basically says that, if you use a Keys franchise product, what we promise you is not necessarily that the product will be the same across cities, but that the service levels and the quality assurance will be the same. So really, Keys will be our route to getting into the franchise model for these 1.6 million rooms, and Lemon Tree will be the route to get into managing those hotels which are similar to us in product and reflect some level of coherence.
Just to get a sense, the whole Airbnb sort of a trend that we saw, an upswing of that, especially post-pandemic, is that still continuing? Is it hurting branded players like yourselves, where people are now quite used to also going to luxury properties or better fitted out properties which need not be branded? Are you seeing that trend reverse or recede, or is it very much there?
It is very much there, and it will continue to be there. But in spite of that, our occupancies are growing. our rates are growing. So what it tells you is that there is certainly a bunch of consumers who like that, who like the fact that, they can get a 3, 4, 5 bedroom villa, for example, in Goa, go in groups and stay there. It gives them privacy, freedom, and so on. So I don't see that as detrimental. I see that as actually increasing demand for transient stay. And I hope it just continues. In fact, Make My Trip has so many of them on their platform that, and I'm sure most of them doing quite well, that, let's think of it as an expansion of the ecosystem rather than the loss. It's not a zero-sum game.
It's not eating into your pie?
I don't think so.
Just as we close this conversation, Mr. Keswani, which I've enjoyed very, very much, I'd like to ask you if there are any sort of numbers you can share in terms of outlook. And let's switch to calendar year because we're speaking in December. For occupancies, your outlook for 2024, for average room rents, average room revenues, and the kind of demand that you think will come in.
So here's my view. Without taking into account that potential inflection point in hockey stick growth, assuming normal industry dynamics and chugging along as if it's business as usual, my expectation is that on a same-store basis, our revenue should not grow at less than 15% a year for the next 4 years, which means it should double every 4-5 years. This will be obviously a combination of demand of occupancy and rates, but most of this will be driven by rate hikes. And because after all, there's a limit to how much you can increase your occupancy from our current levels. So if I did some, forward viewing, I would say we would double our revenues in the next 4 years compared to this year. And this will be in increments of 15-17% every year. And 75% of that, if not more, will come from price increases, which means it will go straight to the bottom line.
And how much are prices going to increase on average?
So I would say, like I have already said publicly, so it's not unpublished and price sensitive. I said we should grow at least 14-15% this year. Okay, and I would reckon that 60% of that would be price, and the balance would be increase in consumption or consumption of rooms. Next year, I would reckon it'll be at least 15%, excluding Aurika Bombay, which will be a showstopper for us on a sum of the parts basis. So same stores, same hotels, I would reckon another 15-17%, which will be mostly price, because by then our occupancies will be at 75-77%. And then going forward, it'll be 90%, 80% price hikes.
Okay, so hotel rooms are set to get more expensive. That's, for those
Sorry, before you, no, Tamanna, before you go off, I want to say something.
Yes.
Hotel rooms are cheap in India. Where do you get a luxury hotel anywhere in the world with the kind of cost that we have, the expense of holding? Because remember, in India, one of the big reasons for expensive hotels is high cost of land, high cost of debt, and the third being high cost or delay to approval. It still takes a very long time to get approvals, to build a hotel and then to open a hotel. And I look at these as factor costs. Then we are as expensive as many parts of the world, where the average rates, incidentally, are double of ours on a dollar basis. So let's not say we are high priced. I say very clearly we are underpriced.
I'm saying we are going to get more expensive compared to where we are. And then everything else is relative.
Yeah, so on a relative basis, we are going to just be less cheap.
Yes, less cheap is another way you can say it. Because if we start comparing in dollar prices, then we must also compare things like per capita incomes, etc., inflation figures. So, okay, we are perhaps well priced compared internationally, but the average Indian may or is likely to have to shell out more. That's good news for the sector from an investor perspective. So thank you so much, Patanjali Keswani, for speaking with us. It's been an absolute pleasure.
Thank you, Tamanna.
Thank you.